Good afternoon and welcome to FBN Charting Points, a technical look at ag markets. My name is Brian Como. Today is the 16th of January, 2024. It's been a hot minute since we've made one of these Charting Points videos. We took a little bit of a break over the end of December and beginning of January. But we're back at her now into the new year, and we got a lot of stuff to talk about here. First, we'll read some of the disclaimers. Trading futures and options involves the risk of loss. Please consider carefully whether futures or options are appropriate to our financial situation. The material is provided as is and for informational purposes only. It is not intended to be a substitute for specific financial, trading, legal, or tax advice. Neither Farmers Business Network nor any of its affiliates make any representations or warranties, express or implied, as to the accuracy or completeness of the statements or any information contained in the material, and any liability is therefore expressly disclaimed. Past results are not necessarily indicative of future results. All right, let's start with some charts. I'm going to mix a little bit of technical and fundamental charts into this report. But first, we'll start off with canola. So first of all, a couple of things I want to point out on the canola chart here is this downward trend line here is still in place, and it is tracking quite closely to the 20-day moving average. So I do believe that this 20-day moving average here, which is around 640 right now, or the downward trend line, which is getting close to their 642 is what it's at today. I think that level is important. As you can see, we've had about a week or so of some kind of grinding higher here in the last little while. And I get asked a lot of questions about, where would we maybe see some resistance or where could there possibly be a pivot point? If we are looking at this market as a downward trending market, which technically that is what it is, we are seeing lower lows and lower highs over time. So that is a market that is in a downtrend. We're also seeing all of the major moving averages currently turning and moving in a downtrend fashion. There are no crosses or anything like that to signal that there is a reversal in this trend happening. So we're treating this very much like a trend downward in this market. I'll explain why that might be happening here when we look at some of the fundamentals. But just from this particular charting perspective, we are in a downtrend, which means that we probably want to take action when it gets into some of these resistance levels like the 20-day moving average or this declining trend line. Right now, those are at 640, 642 respectively. So if you're looking to take an action on this market but don't want to sell the lows, this kind of creep up higher now. We're only $10 or so away from some of those resistance levels. So it could just be the next day or two that we start to hit some of those. Today, it tried to reach up there above 630, closed very close to where it opened again, which is where it closed on Monday. Monday was a bit of an interesting trading day because there was canola trading, but none of the other commodities. So today's the first, major trading day where everything was open after the completeness or the conclusion of the USDA report day. So we're kind of grinding higher here, but as you can see, it's not a slam dunk. The market continues to get pushed back down if it tries to rally. So that means there are sellers in this market. And I think that, as we approach that 640 level, that may intensify. And in fact, I would advocate that you participate in some of that move up into that 640 range. If you are particularly below our sales recommendations right now of 60% on old crop 2023 canola. Just want to also show what that looks like from a monthly charting perspective. So this is where that 640 comes into play. This is the monthly chart here. When we did move below that level, it did kind of punch down. This is the continuous C1. So part of this would have included the January contract. It did push down towards $600. So that means that this chart has made a new low. At the end of December, it had not made a new low yet, but we did punch down below that in January. That is a continued signal that we might be seeing more of a downward trend or some more downward pressure in this market. Now, we always will see rallies inside of downward trending markets, and hence why we would advocate for selling some of those resistance levels like we spoke of just earlier. All right, we're going to talk a little bit about the fundamentals in canola here now. This is the CGC weekly exports. As you can see, week 21 and 22, they do combine in the statistics. those are always low months. And as you can see, we got some seasonal low export numbers. What's really concerning though is the performance through this period here, through week 13 to week 20, as we were kind of approaching the break time. This would be November and December. These are traditionally strong times for canola exports. As you can see, the black line here is the 5-year average. The orange dotted line is last year's performance. So we saw a significant downturn in the weekly exports numbers here. We also struggled through some of the earlier parts of the crop year, the fall period, when exports didn't, from a weekly perspective, make averages or even meet last year's pace. So this export market or this export pace continues to be a concern, which actually has allowed us or prompted us to make some changes to our S&D at this time. So I'll get into that in just a bit here. Here's what this is the same data, this canola exports data, but this is on a cumulative over time versus what the average is and versus what last year was. So, exports are very disappointing right now. A lot of that has to do with the availability of rapeseed in Europe, the availability of canola in Australia, particularly Australian canola that's moving into China, which was a major destination for our own export, raw seed exports. And some of the opportunities that we saw going into Europe as well have disappeared because of the size of the crop in Europe and Australia as well. So we're just lagging. And it at this point, as we kind of got through the early fall, it was still looking like, there's opportunity to turn this around. But at this point now, we're starting to establish kind of a trend of export pace, and it'll be really hard to make a case that this trend is going to reverse and that we're going to see a reversal in the export pace. So that has prompted us to change some of our fundamentals here. Here's what farm deliveries look like. I put this on here just because in some cases, low farm deliveries can mean, that the supply is getting restricted into the elevator system, and that there is a bullish move ahead. I think what this does is confirm the fact that, the demand for canola overall is lower, and therefore the elevators are calling for less canola and are buying less canola in order to satisfy those sales. So we are seeing some of these things trend in the same direction. Now, if farm deliveries had been similar to last year, I think we would be in a worse situation. That would mean that farmers are pushing grain into the elevator without the elevator really wanting it to be there. That would be a bearish thing. Right now, I believe that things are relatively balanced and that the farm deliveries kind of match particularly what the export market looks like. So it's more of a neutral input, but I just wanted to show that just to show, the correlation right now between, the export market and the farm deliveries, the cumulative farm deliveries. All right, so here is what our estimate is on the canola crush for the year, 10.5 million tons. That would be record large, is what we're expecting at this point. We did see back in 2020 that we had a year of 4 or 10.4. We did increase capacity to some degree now. I think with where was that now? My mind is drawing a blank. I think Richardson had expanded one of their crush plants, Yorkton. That's the city I was looking the name of there. So there is some increased capacity that's come online recently, which does allow for an increase in nominal crush values. But as you'll see in a few slides here, where we're running for capacity and how much more that could potentially help this canola situation out. But that's what we're working with. My estimate right now on canola crush for the year is 10.5 million tons. I think we're on pace to make that at this point. Here's the exports. Now, this is what I've amended lower recently, and I amended it lower by about 1 million tons. In previous estimates, I had my canola exports at about 7.5 million tons, and I've now brought it down to 6.5. Maybe I'll back the truck up here. So just to kind of illustrate what that would look like is that means we would need to reach somewhere in here as far as a cumulative total. Now, we're currently not on the trajectory to do that. In fact, we're on the trajectory to do about 6 million tons if we just kind of extrapolate this pace out here. I still have some faith that we will see some demand come in into the calendar year 2024 that will raise a couple of weeks or a month or so of exports that will do well. But I think overall, that's even optimistic thinking at this point. So right now I have 6.5 million tons put into my S&D. I'll go back to that here, which is disappointing. Our canola exports are not are underperforming what our expectations would have been up to this point. And now that we're quite a ways into the year now, it gets harder and harder to make up some of those losses. When you're early in the year and you see some disappointing exports, you're like, well, it'll pick up as we get through fall. If it doesn't pick up as it gets through fall, like we've seen, we start to get into trouble, and hence why we're amending some of our export expectations lower. So what does that do for ending stocks? Well, it increases them quite a lot. We've almost got 2.5 million tons of ending stocks on the books now. So, and this is with Statistics Canada production numbers. So many in the trade agree that Canada is still, or Statistics Canada is still understating the size of the canola crop. If that's true, then this number may even rise from here. But right now I'm using Statistics Canada data on production and my own assessment on demand, which is largely, of course, crush and exports. And that raises our ending stocks number to 2.5 million tons, which is higher than we've seen in the last 3 years. So that kind of helps explain why we're in a downward trending market. Even without the international pressures that we're seeing, say from Australia or from Europe, or other production areas specifically, this is probably the main reason why we are seeing canola prices lag to some degree, and why I would be treating this with a bias towards downward trend at this time. Now, at some point, canola will move low enough to incentivize demand. I don't know what that number is, but when we start seeing, say, China come in on a larger scale, maybe that is, as we move into spring when the Australian supply starts to dwindle down a little bit, or maybe that's even in summer. But that may still mean that the canola price needs to move lower in order to get to that level where there is an incentive to buy it over other origins that may even be cheaper. Now, I don't want to leave everything in the doom and gloom. Here's the weekly crush statistics here. I think this week was 212,000 tons. That was here the last week that was reported by COPA. I mean, these crush numbers are not bad. Like almost the whole crop year so far, save for the last 3 weeks of August here, we have been crushing more than 200,000 tons, 200,000 tons per week. The average crush capacity utilization is somewhere around 95%. That's really good. I mean, that's basically 100%. You can't get to 100% on those statistics. There's always some buffer room or some shutdown or something like that causes the crush plants, not to be able to run 24 hours, 7 days a week at full throttle. And so, I'm very impressed with this crush pace. It is here. I actually have a chart of the crush capacity utilization. So this is 90. I think this is just over 92. I think as an average, we're somewhere around 95, and we're way above average. Now, again, so this takes into account the fact that there is capacity increases, right? So, whereas a nominal number like, 200,000 tons, maybe that's the new normal, right? With a little bit of additional capacity, but the percentages are still calculated based on total capacity utilization, and we're still running really good numbers there. So the crush is really what is propelling this entire canola market along at this point in time. The problem with the crush is that it can only add so much more demand. We can't crush anymore until capacity starts coming online. More and more capacity starts coming online. I think that will be a boon to this market at some point, particularly if exports continue to drag. My assessment was always that crush would take away from exports until the point where there weren't any more to take away from exports. That does nothing but good things for the industry, because the more value that we can keep here in Canada, the better. the more value that we can add before exporting our product, the better. And the more margin that there is then to share around the industry. But right now, the crush industry is doing a really good job. They're doing as much as they can. And just to kind of illustrate what that looks like from a cumulative crush versus last year, is we've continued to accelerate that number. We're about 500,000 tons crushed more than last year at this time, and this has just continued to grow. So this is a really good part of the canola story. Unfortunately, it can only do so much, and the exports would have needed to pick up their socks or pull up their socks and get moving, which we are not seeing at this point. Just to kind of talk a little bit as well about new crop. Now, I do see an opportunity here for new crop. I don't know how big this number is, but here new November canola is trading at $640, which is almost on par with cash at this point. So right now, like or the March contract at this point, what that means is that there isn't much carry into November like there is. There's a little bit of carry from now until November, but there isn't a big discount to November like we often see either. And so if you have been looking at profitability numbers, your inputs and some of those costs may be lower for the 2024 crop than they were for the 2023 crop. So you may actually be able to sell 24 canola at a more profitable level than you can sell your current 2023 crop based on some of those inputs. So that may be a good indication that hedging some of that might be a good idea. And by hedging, I don't necessarily mean just flat pricing. I think giving optionality on getting upside potential and things like that using floor pricing strategies is a good idea, or having some kind of mechanism for a re-entry strategy or something like that to give yourself exposure is good as well. But these prices for November, I think, are really good, and I think they deserve to be rewarded. We do have a 20% recommendation out on new crop. So if you haven't acted on that yet, I still think it's a good idea based on simply just the across the calendar value differential, which is essentially zero at this point in time. So you're not taking a discount on November canola at all to sell that far forward. All right, we're going to take a look at a couple of other markets here. This is soft red winter wheat. So the USDA report did hurt pretty much all commodities on Friday. Wheat was probably one of the least affected, but it did end up breaking below some support. It did move back up to close above that support, which initially, and I might have mentioned that in my morning commentary this yesterday or this morning. The days are blending together for me now, but that was a decent sign. But today we moved lower and closed at even lower values. I think that means that we're going to go back down here and test some support at 560. Again, some of the fundamental reasons for that was that they added about 2 million tons to the Black Sea, so about 1 million in Russia, 900,000 in Ukraine, as well as adding about 2.5 million tons of carryout to the European Union balance sheet as well. So the world is not short of wheat. The market reacted a little bit more muted on Friday, but as we opened the trading day today, it did make new lows, and makes that chart look a little bit more bearish as we move through the week. Same kind of thing with hard red winter wheat. Now we got a pretty good channel trade happening here. It struggles to get above the 20-day moving average when it moves up there. Here's the bottom end of that channel. I expect right now we will continue to trade that channel lower until we get into these sub $6 support areas here. So that we're very close to that now. So if we can pivot on that support level, that would be good. But currently we continue southward in a downward trending fashion. Minneapolis is interesting as well because we actually broke to whole new contract lows. So this is a little bit scarier. The hard red spring wheat market has not been performing all that well. It still is a premium, a pretty decent premium to the, about $1 or so premium to the hard red winter market. So there still is some value left in the higher protein wheat, but just not a lot of it is moving. And the pressures from the lower quality wheats continue to have some weight on this market as well. So this is one where we also continue to feel that there's probably a bit of a downward bias towards this spring wheat market as well. Now, I know we've talked ad nauseum in the last couple of days about soybeans and corn, just because those are the major commodities that the USDA deals with, particularly because we're in the middle of the Brazilian growing season right now. So as you can see, that USDA report hit the soybean market really hard. It traded down to about $12 a bushel. It did rally back, about halfway through the trading range, back up to about 12.20 on Friday. Today it closed relatively unchanged at about 12.27. So, the market tried to rally this, but there isn't a lot of appetite to keep it going either. In hindsight's always 2020. When we broke, this low here, that would have given us some signals here that this market was going to be lower, and then we broke another support level there. To be honest, I think the next level of support is down in the mid 11s here. You could argue that this little one here at 1170 or so is some minor support. But I think this market will continue to trend lower unless, of course, there is some turnaround in how the market is expecting that Brazilian crop. The USDA is still kind of the high watermark on estimates. We've seen, AgRule come out at 153. We've seen CONAB come out at 155, I think. And so, most of the analysts are still below the USDA. But again, that isn't abnormal. And I think the market does discount non-USDA estimates, as they do tend to come in lower than the USDA. But generally speaking, I would say USDA has been pretty correct, particularly when we get to the end of the year and we realize how can Brazil be still shipping beans? 2023 was a good example of this. How can Brazil be still shipping beans when on paper they should be out? And that's because it's really difficult to make assessments, and farmers there, just like farmers everywhere, are not necessarily keen on reporting exactly what they have, and their economy is not as developed as some of ours, the U.S. and Canada, as far as the statistics agencies either. So sometimes beans come out of the woodwork at the end of the year, and 2023 was one of those years. And I think what the USDA is trying to build in some of that kind of fudge number already in, whereas the other analysts may not be. So that might be the risk/reward potential in the soybean market, is if there is lower potential, if there is lower production than the USDA is calling for, then we probably will bottom the soybean market at some point. But right now, the total South American crop continues to look extremely large, and there is a glut of soybeans in the world at this time. Again, I noted in our morning commentary this morning as well that demand from China has eased quite a bit as well, particularly because the size of the hog herd has declined as a result of a larger than average slaughter. So the demand from China isn't coming in as well, and there's a large crop coming. Here's what the corn market looks like. It also made a new low after the USDA report, as carryouts in this market grew. We saw Ukraine add more bushels as well, and I think US and South America, if I'm remembering correctly, all had upward adjustments. The corn market is not short, and this market is pricing that in. And we did make a new low on Friday, and I think that still creates a potential for even lower values as we go forward. Just to kind of illustrate that on the monthly chart, because I'd like to see where the potential is for this market. Some of these, support levels here from a monthly perspective in the 390s, we're still, solidly 50 cents above that. We made a new low now in the monthly chart as well. That's a concern. I think this market still has some potential to continue to push lower. All right, that is all we had for you today. Thank you so much for tuning in, and we will see you again near the end of the week. So have a great week, and we'll see you again on Thursday.